Good afternoon, everyone. It is the new year, 2025, and I hope everyone had a great holiday. I'm Erin Campbell with Beacon Financial Strategies, and I just wanted to take a minute of your time so that we could talk through some tax planning strategies for 2025. So what we're thinking about talking about today is just kind of where we are with as far as tax law goes, looking at 2025. And then at the beginning of the year, it's always a good time to look at retirement plans and make sure that you're contributing the most you can. And then I want to talk a little bit about charitable and Roth contributions. So, first of all, I just wanted to talk about the 2025 and where we're at. So, most of you kind of know that in 2026, we expect the tax law that we're currently under to expire. So, this is the very last year of the Tax Laws and Jobs Act of 2017. So if you look here, where we've been living for the last few years is a 10% and then a 12%. The yellow is the 12. Into the 22, 24, 32, the top rate being 37. If nothing else happens before the end of the year, then next year, 2026, we would expect the 12 to be the 15% bracket, the 22 to become the 25, the 24 to become 28, and even an expanded 33 bracket, 35, and then the top rate 39.6. So these are married filing joint, but single, it's kind of the same idea. I don't think that we'll see an expiration of this law. We just don't know what will happen after the end of 2025. So all of this to point out we're in the lowest rates historically that we've been in for a while, and this is the last year to take advantage of those rates. So I just wanted to point that out. As we think about retirement contributions, specifically, I think a lot about 401k, 403b, simple IRAs, anything you include at work. That is your single largest tax deduction that's available. The new law or the law that we've been in for the last 10 years has such a large standard deduction that most people are not itemizing. And so the one thing that they do have available to them are company sponsored retirement plans, specifically 401k. I get the question a lot, well, my employer matches, and does that count towards what I can contribute? And the answer is no. The match is on top of the amount you can contribute. So for 2025, the amount has increased a little bit. So everyone needs to check their pay stubs, go in, make the adjustment. 401k, 403b simples are all going up by about $500. IRAs and Roth are remaining the same. There is a new tax law in 2025 that's going to go into effect. And so I wanted to point this out for those of you that are affected. So for people over the age of 50, for a while now, they've been able to contribute a catch-up contribution. In 2025, that amount is $7,500. So it's over and beyond the maximum amount that people under 50 can contribute. Well, this year in 2025, we now have a new rule that is affecting people who are age 60 to 63. And that is the age is determined by your age on December 31st at the end of this year. So if you're going to be 60, 61, 62, or 63 on December 31st of this year, you can contribute an extra amount. And for 401k plans, 403b, 457 thrifts, it's $11,250. So that's over and beyond. So that's a super confusing rule because once you turn 64, you go back to the 7,500 catch up. So we kind of wanted to put a graph in here just so you guys could see a table really, what the 2024 limit was and what the 2025 limit is. And so just to kind of walk through it because I wanted to leave this up so those of you who are watching can make sure you catch it. 401k limit in 2025 is now 23,500. Last year was 23,000. Those of you ages above 50, 50 to 59, and then above 64 can do an additional 7,500. So that's 31,000. Those of you who are 60 to 63 can actually contribute $34,750. And so you can see that's quite a bit more in there. A simple IRA, there is an extra catch up for those 60 to 63. It's not quite as much as the 401k, 403b, 457, but you can see down here 16,500. 21,750 if you're that 60 to 63, and then everyone else with the catch up is 20,000. And IRAs and Roths, the limit there is 7,000 and it's 8,000 if you're over 50. So those are the amounts. Make sure you go in and update your pay stubs. you're with your HR people, payroll people, and contribute as much as you possibly can, especially those who are 60 to 63. That's quite a bit more that you can take advantage of. Um, let's talk a little bit about Roth IRAs and why they're important. I thought this would be a good refresher. You don't get a tax deduction when you contribute to a Roth IRA, but you also don't pay taxes when you take it back out. And so investment earnings are not taxed, and then beneficiaries actually don't have to pay income tax on the Roth IRAs either. So we really like them. We want people to take advantage of them as much as they can. There's also no required minimum distribution requirement. So once you're over the age of 73, you don't have to take a distribution the way you do in a 401k or an IRA. And you can continue to contribute as long as you have earned income, even if you're over the age of 73. So I do have quite a few people who have worked past the age of 70 and they're able to still contribute to the Roth IRAs. And so that's a great benefit. Just to point out the adjusted gross income limits, not everyone can contribute directly to a Roth IRA. You cannot contribute if your income is over 240,000 in 2024, 246,000 in 2025. And for single filers, it's 165. So if your income is higher than that, you may not be able to contribute directly, but we would like to point out for those of you who are under that amount, then you can contribute directly to a Roth IRA. As a reminder, 2024, you can still contribute to your Roth up until April 15th of this year. In 2025, you have until April 15th of 2026 to contribute. Switching gears a little bit, I want to talk a little bit about our charitable, some charitable ideas. We have a lot of people who take advantage of this. Early in the year is a good time actually to go ahead and fund some of your charitable vehicles. So versus the donor advised fund, this is where you contribute a large amount to and receive a tax deduction. It's just like a charitable deduction, but you put it into a fund. And so when you put it into the fund, that grows, you can invest it, it grows tax-free and so forth. And then you can spread out the charitable contribution to the multiple charities over time. So let's say you decide, I'm going to give, $10,000 to my donor advised fund, take a charitable deduction in 2025, and then I'm going to give away, in $1,000 a year for the next 10 years to the charity of my choice. So that's kind of how those work. You retain complete control, and you can also involve your family in it. So that's kind of a nice way to support your charity. And it's a good way to take advantage of, a year where you have a lot of income and you need an extra deduction. So the best practices are, we prefer for people to contribute, stocks, bonds, or other appreciated assets. So if you have a question about that, give us a call. We'll help you determine where the best place to take the appreciated asset from and move it into your donor advised fund. We like the idea of bunching it. Again, we talked earlier about how standard deduction is so very high. So it's hard to get a deduction for charity. So, bunching it into 1 year helps a lot. And then, of course, just being strategic with the timing. It's good in a year where you have a lot of extra income. Maybe it's your last year before you retire and you kind of want to set up that fund for the future. So that's kind of what we would prefer you do, is kind of set up that donor advised fund. We can help with that. So just give us a call and we can help kind of lead you in the right direction there. Another idea is the qualified charitable contribution. This is a little bit different than the donor advised fund. So first of all, it's a direct transfer directly from an IRA to your charity. And so it's something that is only available for people who are over 70 and a half. And basically, instead of your IRA distribution being made payable to you, you make it payable to the charity. By doing it that way, you're excluding it from taxable income. That reduces your overall taxable income. And because we just talked again about how it's hard to get that charitable deduction, this is a great benefit for people who are in retirement. They're over 70 and a half, and they can make that QCD, their charitable contribution, directly from their IRA. One quick note, 401k, 403b plans, you cannot do a QCD. You have to do it from an IRA. And donations are made directly to the charity. It can satisfy your required minimum distribution. So for those of you who are over age 73 and are required to take an annual distribution, you can use this as part of your RMD. So it satisfies that. And you can reduce your taxable income. It's up to $100,000 per year from the IRA. So if your IRA distribution is pretty large, or if you have to take money out and you like giving money to charity, this will be a way to do it. But That's a great benefit. So it's great for people who are high income because it can reduce your Social Security to tax impact of Social Security as well as the Medicare premiums. Those of you who are paying Medicare premiums know that if your income rises, then you end up having to pay a little bit more Medicare. So this is a way to control that by giving the money directly to charity. And if you're a charitably minded person and you're thinking about, estate planning and so forth, this may satisfy some of that. So giving to the charity while you're still living is a good plan. A table just to look at the differences between donor advised funds, qualified charitables. You can see here that, donor advised funds are usually come from a brokerage account. It's usually appreciated assets. Qualified charitable, that's coming directly from the IRA. The donor advised fund, you can control how much you give to the charity over time. The qualified charity, you have to give directly to the charity that year, so you can't control that as much. And you can see how it's the age requirement. 70 and a half is the QCD, but there's no age requirement on the donor advised fund, so that can be a way for younger people to contribute to charity. In general, we like doing these towards the beginning of the year. And that may not line up with what you're thinking as far as you normally give maybe a big charitable contribution at the end of the year, but going ahead and setting these things in motion, making sure that the IRA is paid to the qualified charity or that the donor advised fund has already been funded for the year. It takes a lot of stress off the end of the year for those of us who are having to make sure that these things happen. So if this is something that's of interest to you, make sure you reach out. We'd want to go ahead and get the ball rolling on that as soon as possible. We talked a little bit about the Medicare premiums a second ago. For those of you who are in Medicare age 65 and up, you probably are very aware of how this works, but in general, the 2025 Medicare premiums are going to be over here, $185 per month per person for Part B. This is based on the 2023 income tax. And so we're looking back 2 years and the IRS Social Security Administration looks at it and says, okay, well, if you were over 212,000 of income, adjusted gross income, then you start to make a leap. So up to 259. And so when you're about 63, you kind of have to start paying attention to this and see what your income is, because you will see an increase in your Medicare premiums once you're over age 65. So just something to keep in mind. I wanted to point it out and kind of see what the premium jump is for 2025. So in general, I just wanted to recap. We don't really know what's going to happen to tax laws. We know where we are for 2025. We think we'll stay there for the rest of the year. But beyond that, we really aren't sure exactly what's going to happen. So we want you to maximize your traditional 401k contributions, especially if you're in high earning years. Some people are contributing to Roth 401ks. We like that fine, but you're not getting any kind of tax deduction for that. And because the traditional 401k is your biggest tax deduction, we'd want you to max out that amount as much as you possibly can every year. If you're eligible, if your income is low enough, we want you to contribute to Roth IRAs. There's other ways to get into Roth IRAs, but reach out to us and we can talk about your specific situation. And then think about your charitable strategies, such as donor advised funds and qualified charities. So donor advised funds we think of more for younger people, qualified charitable for people over 73. So that's kind of what we're thinking. As a recap, that we've got tons of information on our website. We've got podcasts, we've got web presentations. I know we did a looking ahead at 2025 webinar late last year, kind of thinking about investment markets and where we are. But we've also got articles, so we encourage you to kind of visit there, listen to our podcast, read our articles, things like that. And then, of course, always reach out to us for any more information. And we hope you've enjoyed this presentation, and we will talk to you soon. Have a great year.